Welcome to the Remarkable Retail Podcast, Season 3, Episode 14. I'm Michael LeBlanc.
And I'm Steve Dennis.
Well, in this episode, Steve, you and I are talking about something that you and I have been involved in for a long time, e-commerce. Specifically, what we or analysts or everyone kind of gets wrong about e-commerce from a strategic perspective.
Yeah, this is something I talk about a little bit in my book, but I've been really digging into, and we've dug into in some past episodes, just that there's kind of this monolithic view of e-commerce as being one thing, which, if we go back a while, was largely true. But as various retailers have gotten into different sort of products and there have been different ways of fulfilling them, the definitions getting blurrier and blurrier. And one of the things I thought would be good to talk about today is just, okay, let's level set what we're talking about, but more importantly, what's the so what? Because some of the takeaways from some of the high level narratives, I think, aren't particularly useful.
Right on, right on. All right, we'll get to that in a bit. Let's now get to news of the week. Now, we have got a bit of a new format for the listeners and viewers. We're going to focus on the top 3 things that we're looking at for the week. So, leading off, again, we almost never talk about them. Amazon, however, they put out some results that were A, difficult to parse out what the heck's going on, and B, if you start to parse it out, don't look that great. What do you think?
Big disappointment on the overall earnings front. They missed on sales, they missed on profits, and they guided lower for the balance of the year. Amazon manages to get away with the widest range of earnings. I think they said our profits in the final quarter will be between 0 and $3 billion or something like that, which is okay.
Somewhere in there. Yeah.
It's nice to be that big where plus or minus a couple billion is enough to satisfy Wall Street. But it was quite interesting when you look at some of the numbers. And I just want to say, Andy Jassy, I'm sure you're listening. Let's try to provide a little bit more detail because it is really hard to parse out the numbers because there's this big Amazon warehouse or web services number, then a bunch of other segment stuff, which blends things together. But the headline was that sales slowed down a lot. And if you look, I'm going to have to use my cheat sheet here. But if you look at some of the overall sales, web services was great. But online, first party online from Amazon was up only 3%, which is well below the overall growth rate for e-commerce. Their third party part was up, I guess, a little bit better than the industry, up about 18%. Interestingly, physical retail, which is mostly Whole Foods, but the grocery store, 4-star, starting to become a bigger piece, that was up 13%, the first time in a while. But, my conclusion, if you look at all the profitability in web services and you look at the lack of profitability in all other, in all other is advertising, which is phenomenally profitable. Prime, which presumably is really profitable. Third-party services, Amazon takes a fee for that. So that would seem to be possible. So I think all roads lead to their own retail being very unprofitable, which, the long-term narrative had been that Amazon doesn't make any money in retail, and that's really not so true. But I think we're seeing a lot of recent suggestions that not everything is great in the retail part of their business. But 2 quick things on that. They did talk a lot about how their costs are going through the roof. I think everybody's getting hit with all the shipping and fulfillment stuff, though Amazon seems to be worse on that front. Labor costs, those sorts of things. So it's a little unclear whether there's kind of this long-term trend of this profit squeeze on fulfillment against retail, or whether this is, infrastructure building, and whether this is things they need to do for the next few quarters to deal with the supply pain and labor shortages and COVID overhang. But last fun fact, Amazon Web Services became the largest percent category for Amazon overall for the first time. So in addition to its tremendous profitability, it is now also the biggest revenue contributor. So just a lot going on in Amazon as always, but anytime earnings come out, it gives us a chance to try to figure out what the heck is going on. But if they would break out more stuff, it would be a lot easier to dissect what's real, what's long-term, and what's just kind of a short-term investment or a short-term COVID supply chain related issue.
Yeah, you could really make a career as our friend Brad Stone has done, writing about Amazon, because it's so interesting to pick apart. Jason Goldberg, for example, does a great job when he looks at the
Yeah.
results, and we've had them both on the show. What jumped out at me, what was interesting is a couple things, as you say. Jeff Bezos said early on in COVID, "I'm going to inoculate the supply chain, and I'm going to dedicate billions of dollars to doing that." I mean, he would be
Yeah.
the same. He'd be in the same place. They move a lot of goods. Everybody moves a lot of
Hmm.
goods. They'd be still struggling. What jumped out at me that was interesting, I don't know what it means, but they're now shipping more goods apparently than FedEx. But
Yeah.
the objective of the game isn't to ship more goods; it's to make the most amount of money. And I know that the courier companies are actually shedding clients,
Right.
unprofitable clients. I wonder if Amazon's picking up the unprofitable clients, and that's a whole other line of business. And it's a complicated line of business. So I guess the short answer
Yeah.
is more to follow. With lots to talk about with these folks. I mean, retailers are complex businesses. They are complex on steroids.
Hmm.
So more to follow on Amazon. All right, let's move on to our next thing. I think you described it as potentially the worst job in retail.
Yeah.
From my one of my former companies, Levi Strauss. JCP has a new president and CEO. Talk about that.
Yeah, well, Mark Rosen, senior executive at Levi Strauss, formerly was in a senior role in Walmart eCommerce. So, very experienced guy. I don't know him personally, but people that do have said great things about him. So, I'm sure that he is a great guy. But yeah, the JCP CEO job. Good luck and Godspeed. That's all I have to say. I hate to be so negative on pennies, but it is
Yeah.
such a damaged brand with so much competition, and there are so many things that have to be radically changed in a very short period of time. They basically got a lifeline coming out of bankruptcy because of this deal that some of the mall owners got involved with. So that does give them some flexibility that they might not otherwise have. But good luck. I'm sending them a copy of my book and probably some rosaries or whatever. I don't know. I'm not sure. I'm not a religious guy. I'm
Yeah.
not sure what sort of thing to send them. But anyway, it's yeah. It's just. I think it's an impossible job. It says nothing about him. I'm sure he will try a lot of stuff, and I think in a couple of years we'll be talking about the
Yep.
world's second longest liquidation sale. Unfortunately.
Yeah. Waiting for the penny to drop, as we've been saying for the past couple of years.
Yeah.
As an executive, I could see it, because if and you're right, he's been very successful. Levi's brand has had a renaissance, as it kind of ebbs and flows all the time. It's got a bit of a tailwind from COVID, actually, because people said, "I'm going to dress up. I'm going to put jeans on," from my track pants. But it's a nice, maybe it's his farewell gig, and maybe he says, "Listen, I'll take a shot at it. Maybe it'll work out well." There's probably a fair bit of money involved, so it's not
Oh
a
yeah.
bad way to spend his money. And it's and for any executive at that level, he said, "What's my next challenge?" Boy,
Yeah.
it's tough to
Sure.
find a more challenging gig than JCP. So we wish him the best, and
Yeah.
we'll be watching.
Yeah,
All right,
absolutely.
last but not least, in our new roundup, let's talk about Rent the Runway. So they did their IPO, they went public, the stock popped, the stock dropped. Observations out of the numbers coming out of there, and what's happening with our friend Rent the Runway.
Couple interesting things here, and I suspect we will be hitting on this just about every episode until the stock market crashes. is It's just this run.
Set your watches.
Such a why? I mean, it could have happened as we're talking. Just this
Yeah.
run for these digitally native brands, new direct to consumer brands to go public, taking advantage of kind of where they are in the investment cycle, but the really, really frothy valuation. So Rent the Runway, yeah, went public the other day, jumped at the outset. Then I guess cooler heads prevailed, or some of the other people that made a little bit of money on the IPO, uh, took the exit ramp. And who knows? By the time this episode comes out or people listen to it, could be a different story. But I think we're just going to continue to see until the music stops, the pets.com part 2 hits us, that people are going to be trying to get into the public markets as fast as possible. The thing to me that continues to be interesting about some of these brands, which have very high profiles, a lot of people following them for the last year, being these super sexy disruptive brands. Well, here's yet another one that is not a very big business. They do under the $200 million a year, which is nothing really in the whole world of apparel. And they managed to lose about $1.10, I think, for every dollar they took in. So another one of these profitless prosperity companies. Now, to be fair, they are obviously investing in the business, and COVID was not very friendly to anybody in the higher end part of the fashion business. So I think it's pretty hard to really look at the profitability numbers right now. But I think just like we're going to see with some of these other brands, 2023 is going to be much more challenging for e-commerce companies. We've got this kind of rebalancing to some normal. We've got a lot of pressures in terms of digital marketing and just a ton of competition. So I think most of these companies that have gone public or been public for a little while, each of the quarters going into next year are really going to be the ones that'll give us more guidance as to whether this is a real business or just kind of a moment in time kind of business.
Yeah, I think for them it becomes a bit crowded. I was interested to read Daniel McCarthy, our great guest, and number one episode, by the way. Congratulations, Daniel. He was talking about, as he pulls apart the numbers, he was talking about their depreciation rate on their rental goods, which he tracks at about 20%. So check out his comments on Rent the Runway and their business model, which are very insightful, as you would, as you of course would imagine. Now, you did say e-commerce in 2023, not 2022, is going to be more difficult.
Yes, that was yes.
If you want to,
well, no, I did.
It
mean
probably will be too. It probably will be too.
Well, I think it's gonna take a while, certainly, for us to sort through all the noise. But I did mean 2022, and the reason why I focused on 2022 is because we start to anniversary a lot of the COVID specific effects, and that will for the businesses that aren't for real, that will have a significant dampening effect on their sales, and we'll start to be able to see more clearly whether the return on advertising is working well. As some of these retailers go further into opening stores, we'll start to really get a sense of, well, can they open 5 or 6 stores? Can they open 50 or 60 stores? Or can they open 100 plus, as some of them have said they want to do? And that's going to be pretty challenging. So the store ramp up is probably much more a 2023, 2024, but the overall trajectory of the business, I think every quarter in 2022 is going to be pretty interesting.
All right. Well, that's exciting. Lots to watch. Lots to watch out for. Lots to pay attention to. Let's get on now to our segment. You and I are just chitting and chatting about e-commerce. But before we do that, I want to take the opportunity to remind the listeners to check out Remarkable Retail on YouTube. Our episodes are up on YouTube and some extended content. So do make sure and do that. And I wanted to give a shout out to Conversation with Commerce Next, my new podcast. So tune in with that. It's more about careers and DTC. But for now, let's get talking about this whole e-commerce and what we get wrong about it. All right, Steve, you and I both together have actually a pretty good background in e-commerce. I started it with Levi Strauss back in the late 90s in the go-go, will the vendors win, will the retailers win? And then Hudson's Bay and a bunch of other stuff. And you as well have a great pedigree in e-commerce. So this episode, we wanted to talk about e-commerce and frame it in such a way for the listeners where so much has gone on thanks to the COVID era, the great acceleration, curbside, so many moving pieces, delivery. And I guess you and I were just talking off mic. We wanted to talk about and tell the listeners about what we think the right lessons to learn are from what we've just been through to help us think about what's coming next. Is that the way you're thinking about it and e-commerce as well?
Some of it's definitely specific to COVID. Some of it is also kind of the arc of e-commerce and how it's developed over the past 20 or 25 years. But I think there are a lot of kind of false narratives or just misinformation that's out there. So some of it is about straightening that out if we can. But more to the point is, what's the so what? Because I think sometimes we see, whether it's reporters or investors or retailers, taking perhaps the wrong or less than helpful message away from what's transpired for many years, and in particular what's transpired over the past 19, 20 months.
What amazes me sometimes is that we're still talking about e-commerce. Like, we were talking about it in the late 90s as the next coming of retail, and we're still talking about it all these years later. And as you say, Um, Often people are still getting some things wrong about e-commerce, and as you've often said, and maybe we're kind of foreshadowing the end. It sometimes can be thought of as a distinction without a difference when we talk about e-commerce and these, as you've often said, these blurring of the lines, which really kind
Right.
of opens the mind to that, right?
Well, I think at a certain point, it's all just commerce, right? Most customers are active online, they're active in brick and mortar. There's often this symbiotic relationship between digital and physical. So maybe we're going to the store and then we choose to order online when we get home, or we're researching online
Yeah.
and then going to the store, or ordering online, picking up at the store. So over the arc of e-commerce, we've seen the blurring or blending just become pretty much the core part of what we talk about when we talk about commerce. One of the things that just to kind
Mm-hmm.
of level set on some of the nomenclature, the other thing that I think has become interesting over, I guess, really over the last decade or so is if we go back to when you and I first started working in e-commerce, mid to late 90s, e-commerce was really kind of a better mail order catalog. It
Right.
was
Right.
you ordered online or you got marketed to online, maybe still got some catalogs, but the marketing
Yep.
was more digital, the ordering was more digital, but the way you got the product for the most part was it was picked, packed, and shipped in a what was previously a mail order catalog type of fulfillment, and it was sent to your home
Yep.
or office. So there was ordering online and there was online fulfillment. It was a pretty specific set of things. That's what Amazon originally did. The legacy retailers that we worked for the most part, that was how they got into online, was kind of this advanced catalog market. And the lines between brick and mortar shopping and online shopping were fairly distinct back in the day. What started to happen, and I guess for the most part, Amazon probably led this, is Amazon started to um, offer up more and more product categories. Initially, most of those product categories, those still fit into this fulfillment model. Ordered it online, fulfilled through a pick, pack, and ship sort of operation. But when they started to get into groceries, when they started to get into frozen,
Mm-hmm.
uh, refrigerated, fresh product, well, most of that doesn't go through that, or can't, as a practical matter, go through that system. So the
Right.
fulfillment started to change to more local delivery. And then a lot of retailers started to follow. So you started to get this blurring more on the fulfillment, where yes, I'm still ordering online. It's still largely digital in nature, but the supply chain part of it started to shift. And some people thought, well, why can't I order online, but actually pick it up in a store? Or why can't, if I bought something online, why can't I return it to a store? So suddenly the role of the stores in fulfillment started to become more pronounced. So the last few years pre-COVID, what we called e-commerce, which used to be basically I order online and it's shipped to me in a certain way, and frankly, stores don't have much to do with it other than maybe the marketing part of stores. We've seen this world kind of come together, have it get more complex. And then when we get into the COVID era, well, number one, we have this distortion of online ordering for sure. But we also
Yep.
had this distortion of stores being involved in what we call e-commerce, because we had a lot more curbside pickup. We had a lot more buy online, pick up in store. We had a lot more buy online, return to store. E-commerce orders are being fulfilled out of store stock and sent through the mail, or through some sort of local home delivery, whether it's shipped or Instacart. So when we talk about the growth of e-commerce, it's not that first few waves of e-commerce, which was probably pretty much one way of doing things. Stores didn't matter. This last era, particularly during COVID, has really caused the blurring and the blending. And it turns out that
Mm.
actually stores, in many cases, are pretty central to it. So is it really e-commerce if I order it online, but the store delivers it, or it comes out of store stock? I don't know. I don't want to get into the
Yeah.
semantics. It's really more the so what I think that we should talk about.
Well, many great points, and it's a valuable lesson that we should learn from history. Because back in the late 90s, mid 90s, early 2000s, it was like, why do we even need stores? Let's just have e-commerce. If e-commerce is where all the growth is going to be, why do we even need stores? And I think you and I were probably, we didn't know each other back then, but we're probably thinking the same thing, is if you want to turn $1 billion business into $100 million business, get rid of your stores and you'll have a,
Yeah.
a tiny e-commerce business. That's not the objective. This syncopation, the synergy that started to come together. And we're even seeing that now. We can talk about, as Saks and even Macy's, you were in the news last week talking about the pressure on Macy's to split the divisions. So these issues still come back and forth. Some are more structural than notional. I wanted to touch on something you talked about. Oh, go ahead. Sorry.
I was going to say, well, there was, and it gets a little bit back to the point I was trying to make about the definition and making more than semantics. In the early days of Amazon, and Amazon's still 40% of all e-commerce transactions. In the early days of Amazon, where they had no physical presence, there was more of this zero sum game kind of notion, right? That anything that got lost to Amazon or Etsy or Wayfair or these real pure play
eBay,
online, eBay, that was coming at the that business was coming from somewhere, and it's coming out of the legacy players. So there was this kind of zero sum game. As stuff moves online, physical retail loses. But as I was saying, as time has gone on, as legacy retailers have gotten very strong .com presence, and as we've seen somewhat ironically, not only Amazon, but a lot of these digitally native vertical brands open their own stores. It's not a zero sum game anymore. It's a both and kind of thing. So the retail apocalypse narrative, or the why should we invest in stores because they have no future, it's all moving online. Well, that's a little bit overly simplistic in many categories.
When we think about what the industry, what observers, what some of us sometimes get wrong about e-commerce, let's tick off a few boxes here. You mentioned, of course, the incredible growth in e-commerce that happened because of COVID. How incredible was it really? When I think of incredible growth, where I think it is true that it did actually move forward in years,
Sure.
is in the grocery sector. But in general, we heard this, it's gone forward 10 years. It's gone. What do you think? I think it advanced an already predetermined growth pattern.
Yeah.
Yeah, I wouldn't say a bit more than a bit. What do you think? And where do you think the lasting difference of the last 18 months is on e-commerce?
Well, the thing that was clearly wrong, and I got, I think we talked about this on another episode. I got into kind of some interesting Twitter wars. And by interesting, I mean useless. Was that when there was this narrative that we've accelerated 10 years in 8 weeks or whatever it was, and McKinsey wrote about it, and there was all sorts of stuff flying around the internet. It was pretty obvious, just you didn't have to know very much about math to realize that when the denominator crashes, it's pretty easy for the percentage to look higher. But there was going to be a point in time, save the world being wiped out entirely, there was going to be a point in time in which stores opened and we were going to revert somewhat closer to the mean. So this whole 10-year idea, just the data clearly doesn't bear that out. It's more like 2 or 3, depending upon the category. And I agree with you that grocery was the one which has been, is a huge category, has historically had very low penetration as compared to apparel, which is like 30, and books and music and things like games, 60, 70%.
Yeah.
So grocery was the one that could move the dial the most. And certainly people's interest in curbside pickup, home delivery was greatly escalated. People were eating more meals at home anyway. So you had kind of the double whammy effect. So, but we're still at this period where we have seen, for the most part, settling into kind of that 2 or 3 year acceleration. But certain categories are still a bit distorted, as people are slow to go back to restaurants, slow to go back to vacation travel, those kinds of things.
Well, that's a good point, because in an upcoming episode, we're going to have 2 grocery experts talk about the future of grocery, because there's a whole bunch of things that went on in that. So that's a bit of a tease for our next episode, Dr. Sylvain Charlebois. And we've got David Marquette from Kantar to talk about the future of grocery, given what they've just been through. So that's a good lead to that. The other thing we should probably talk about is where it's the prognostications about suddenly where it's going to wind up. So depending on the way you categorize core retail or retail, what you put in, what you put out, take out automotive, put in gas, all these things, we're probably in 18, what in the US, 18 to 20% of core retail done
Right.
online.
Right.
E-marketers calling the ball at basically 25% by 2025, which is not, that seems to be reasonable. Some highs, some lows.
Yeah.
I hear this 50-50, 50 by 2050. I don't know if it's 2050, but this 50% blend e-commerce. It seems, I don't know. It seems far-fetched to me. Or maybe I'm thinking about it wrong. Maybe it's a definitional issue, as you say.
Well,
What do
it
you
is
think
a
the
little
trajectory
bit of
is?
a definitional issue. If we're talking about transacted online and more of the online fulfillment, not involving a store, there's no way we get to 50%.
Right.
Some of it is just, I have generally used in terms of the e-commerce penetration, that at least in the US, e-commerce has been picking up share at just over about 1 point for the last 10 years or so. That got pushed up, as we just talked about a little bit, by several points. But it looks like, if you look at most
Yeah.
of the forecasts, we're going to be back to more of, the 1 to 1.5% penetration, which is, I think, if you play around with the numbers, it's like a 10 to 15% overall growth. So to get to 50% on a larger base, something dramatic would have to happen that would allow e-commerce to grab share much more quickly than it did even during COVID. And who knows, like, I can't think out to 2050, but we're certainly not on that trajectory. And it gets to one of the other points about what I think is often thought of, is that kind of anything that can go online will go online. And there's a couple things that we have to think about there. One is, can go online. Pretty much every product you can imagine, short of getting a
Sure.
haircut. Well, even there, like, you can book an appointment online. Is that e-commerce? If you're going to get, this is where
Right.
we get into these sort of semantic issues.
Yeah.
Yeah,
Right.
it's
Right. I can
right. You're
I could buy
learning
gas
about it
online.
online. You're
Typically.
booking it online,
Yeah. Yeah.
but
Yeah.
the performance. But for some reason, that's, people think of that. Well, that's clearly not e-commerce. But, well, if I order online, I basically reserve a product online, and then I go to get it at a store, and the product was already in that store. Somehow that's e-commerce in a way that getting your haircut isn't. I don't know. Again, you get into kind of these semantics issues, but
Yeah.
I think there are practical limitations or shopper preference limitations to certain categories getting to that 30, 40, 50% share. I think, a lot would have to change for people to not want to, for the most part, sit on that sofa, try on clothes, um, pick out the seafood at the counter. There's certain things where, not to
Yeah.
say it doesn't happen at all, but there's certain things where
Right.
physical retail really adds a lot of value. If you look at what RH has
Yeah.
accomplished with their gallery stores, they actually
Incredible.
haven't invested very
Incredible.
heavily into e-commerce, even though home is a reasonably well penetrated category. But that's because the stores add value. You can see all the product, you can try it, not try it on, test it out, etc. So there's some
Yeah.
inherent barriers, I think, to these very high e-commerce penetration shares. The other one, which we should probably talk about a little bit more, is there's just the underlying economics. Some of these categories
Right.
are just
Right.
terrible e-commerce businesses. Selling music, selling an album online that can be digitally downloaded. Well, that's a great business, right? No product costs, no distribution costs, essentially. Trying to get groceries to be profitable, or some other product categories, there's a lot of demands there. So I think the profit headwinds, or the amount of investment that would have to go into some of these to take that e-commerce
Yeah.
penetration from 5 to 15, or from 15 to 30, 30 to 60. We shouldn't lose sight of that, because it can be significant. And it's been kind of glossed over because of what people had to do during COVID, either to stay in
Yeah.
business or just respond to the crisis.
Now, there is a school of thought, the old saying in retail, right? Volume solves some sins. That as the growth of e-commerce grows, pragmatically, a courier can do 10 times more drops, as they would say, in a neighborhood. So there starts to become an efficiency as e-commerce. Like, I wonder if there's a tipping point in some categories. For example, if you're a big grocer and you're running e-commerce, at some point, it's very expensive to deliver 10 orders a day. But if you're delivering 500 orders a day, the incremental expense. So I think on the other side of the economics discussion is there's a lot of great retailers who are making good money. I mean, you're familiar with Land's End. You came out of the Sears organization. I can think of a lot of retailers who actually make good money doing e-commerce. And one of the things that it leads us into a discussion on is how fast it actually needs to get to the doorstep.
Right.
What do you think about this kind of race, literally a race to the doorstep? It feels to me like it's a bit of a mug's game that's been set up by some big players because they have experience or they have scale, but it's not always the case. And it can be a huge cost driver that kind of eliminates your profitability. Where do you think it's going, this speed to the doorstep?
I love to quote my friend Seth Godin quite a lot. And one of my favorite quotes from Seth is, the problem with the race to the bottom is you might win, or worse, finish second. And I think this is definitely
great quote.
An issue. Well, to your earlier point, having worked in last mile delivery off and on for many, many years, it's not so much that volume automatically solves all problems or cures all sins, but the route density with home delivery is critically important, and it does start to change the game if you're talking about home delivered product and expensive to handle product, refrigerated, fresh, that kind of things that you can't send for the most part through UPS or whatever. So I think if you're Amazon, if you're Walmart, if you're Target, and that may be the end of the list, you are very focused on getting your supply chain, last mile delivery configured in such a way to get those economics to work. Everybody else, it's really hard to play catch up. And I think it looks like Walmart, Target, a bunch of others are in this convenience war where if 2 days was great a few years ago, then next day is better.
One day's better.
Next day is great, then same day. And if same day, then it's within an hour. And these are very expensive things to do. And I think part of where you're going is, does the customer really need it? In many cases, no. If you offer it, will the customer, let sample of one here, but I was ordering some things from Amazon and they said, well, you can get it in 2 days or you can get it in 1 day. Also ordered something from Best Buy. You can get it in 2 days. You can get it in 1 day. You get store pickup. Same cost. I was like, I don't know. Why not tomorrow? Do I need it tomorrow? No, but you offered it to me. So you've allowed me to pick the more expensive option. And maybe I'm a jerk, or maybe I shouldn't be worried about their supply chain costs. But we've created a lot of things in the system. Free returns drives a lot of costs. So there's a lot of things that have become kind of table stakes, or retailers are making table stakes that everybody feels, or many people feel like they've got to compete with. But ultimately, it makes the economics worse. So I have a theory. That
what's your theory?
This is Amazon's, part of Amazon evil genius. They are the leader here. They are investing massively. They can, and they're just like, come follow us down the rabbit hole, or whatever is the right analogy. Like, go ahead, make my day. Yeah, we'll because we'll keep ratcheting it up, and we can afford to do it. Maybe not over the long term, but we're in position to do it. And every time you try to keep up with us, you just make matters worse. And eventually you're going to say, no mas, I can't. Either you're like, your board or your investors are going to go, what the hell are you doing? And you're going to back off. And then that's just going to allow Amazon to gain even more market share. So that's a long way of saying, it is a bit of a race to the bottom, and, only a few people have a chance of surviving that, much less winning it.
I want to wrap this part of the episode just talking about where it all began structurally in some ways. I remember the days in the organization, you would say, the executives would say, we're going to launch an e-commerce business and we're going to compete. We're going to structure it differently to be a whole different department in a whole different building. And your job is to take share away from the brick and mortar guys. And I want some good old fashioned competition. And from that, from that intensity of that competition, great things will happen for the shareholders. Okay.
Yeah.
Fast forward 25 years, and we've still got some organizations who are saying, we're better off spinning. Maybe there's some financial shenanigans or financial benefit, but we were talking off mic, and you were on CNBC with Lauren talking about, maybe there's an upside to that, and the consumer doesn't really experience anything different in a perfect world, and maybe the accountabilities change a bit. Talk about the pro and con about doing this kind of spin and financial wizardry.
Yeah, I was thinking, I remember when I was working on my book, and I talked about how when I was at Sears, we very much built the .com operation with the idea that would always be integrated with the store, that we were one brand operating in different channels, even though we gave them some room to run, where Walmart was opening up and Kohl's and Target and a bunch of others were doing the spin out thing. So when I've talked to reporters over the last couple of days, I'm like, I feel like, 2001 called and wants its press release back because this separation thing is such an old idea. And
yeah,
have we learned nothing in 20, 25 years?
Right.
So it is bizarre. The kind of clearly there are things going on in the financial markets where these valuations are, I think, artificially high. So I would hurry if I'm them to try to get, if you're going public as a digitally native vertical brand, or you're spinning out, like go, because whether it's 2 weeks from now, 2 months from now, or 2 quarters from now, this will end badly. Having said that, one of the things that I think is interesting, so my experience in trying to pull things together, first at Sears, then at Neiman Marcus, and over the last few years with several clients, is it's hard enough to be customer centric and get the different silos in the organizations to cooperate when you're under the same roof and you have the same CEO and executive structure. So the idea that you would
the same bonus
deliberately
structure,
bonuses and set, like you name it, right? Same offices. So the idea that you would intentionally separate them, as Saks is doing, as Macy's and maybe Kohl's is rumored to be doing, just seems like insanity and seems like it's an impossibility. However, one thing that apparently Saks has done, which people may have read about, is they've created all these agreements about how .com is going to serve stores and vice versa. It still seems incredibly cumbersome. It seems next to impossible to fully value the advertising role of a store. Or if I see a digital ad, does that drive me? Like, there's tons of attribution issues, which I don't know how you could ever completely get your head around it in a fair way. But to actually sit down and, instead of negotiating among colleagues how to get things done and having the CEO be Solomon-like in the decisions, to actually go through and hire Bain or McKinsey or somebody to like dissect this and create agreements and reduce these processes, maybe that actually addresses some issues in a more aggressive way. And because it's a transaction and a deadline, it's like, well, we got to go figure this out. It's not like, oh, we'll figure out how to combine our marketing departments someday.
Yeah. And here's the SLA. You said you do X and now it's in Y, as opposed to the kind of the casual inferences, right? It's black letter law in the SLA. I hadn't thought of it that way. That's a really interesting way to kind of wrap this up, that there's potentially a bit of upside to this stuff that's going on that, as you say, takes us back.
I will say, though, I think even if you do that perfectly, what's perfect, but even if you do that extremely well, the thing that I have the hardest time getting my head around is there are so many intangible factors of brand and so many issues of attribution. So if you're Macy's and you're spun out, what is the value of the equity that has been built by Macy's over more than a century? What is the value of driving past that Macy's store that makes you go, oh, maybe I'll buy something online?
With the Amazon ad on the top of it. Yeah.
Right. So I think and similarly from digital to physical. So even if you say, well, it costs $8 for you to send somebody to go pick up the order and take it to curbside, so I'm going to pay you $8 as a service. That's pretty straightforward. Sure, people could argue about what the right number is, but that activity is a lot easier to reduce to practice and come up with a cost for it. But the brand value, the experiential value, the acquiring customer in one channel who then becomes a repetitive online customer or acquiring somebody online who comes to the store.
Better customer.
Like that is, people have been trying to do that well for ages. Nobody, as far as I know, has done it in a very comprehensive way, and it's not going to get any better for a given brand if you split things out. So that's the one that I think is the hardest to see how you could fairly address that. But we'll see. I think the Saks thing is going to happen. I think the Macy's, Kohl's, and some others are probably either cooler heads will prevail, or when we start to see the moderation in e-commerce numbers, people's ideas of what the .com is worth they'll be tempered a bit, I think.
Or the financial momentum will just take them over the top, and they'll do it anyway because they, as you say, see an opportunity that doesn't come along every year to add that kind of enterprise value to a place like Macy's, right?
Right.
Oh, we'll
and then
see.
my investment advice would be, and I generally don't want to give investment advice. My investment advice would be about the best short that would be out there would be take all these .com stocks and short them, because I think it's going to be one bad quarter for a couple of these guys. And, there's no way, there's not going to be 56% growth in e-commerce as we get into 2022. Those numbers are going to be, for some people, under 10, in a lot of cases in the teens. And then all of a sudden people are going to be like, whoa, this thing maybe is not, it was great. Like most retailers would kill for 15%, but this idea that, it's going to go to the moon and have a $50 billion valuation or something, I think cooler heads will start to prevail. Not to mention, if there's any kind of major market correction.
Well, you heard it here, folks. Buy low, sell high. Steve Dennis is your investment advisor. Wise, sage-like advice. Great conversation.
Worth exactly what you paid for it. Remarkable Retail Podcast listeners.
Worth the price of admission. All right. Well, listen, great episode talking about e-commerce. I'm sure not the last time we'll be talking about it. And next week, we'll be talking about it a bit more, actually, in the context of grocery and a whole lot more. So until then, let's wrap this episode.